Hello, Econ students. So, this is what we've covered so far in the business cycle. We've got GDP, inflation, unemployment, and what's happening both during expansion and recovery, as well as during a contraction. Just today, or yesterday, I should say, we talked about contractionary fiscal policy being put into effect during an expansion, where the government would raise taxes and lower government spending to slow down inflation, to get people to stop spending their money so much. And during a contraction or a recession, when the economy is doing really poorly, they may put expansionary fiscal policy into effect. And that would be in order to speed up a slowing economy. So today we're going to talk about monetary policy. And to do so, I have my wife on board with me.
Hi, everybody.
That's my wife, Christine. I told you my incentive to get you to watch this video is that you get to hear her voice.
Aw, how sweet.
So I put a link in Canvas to this video. Hopefully you've already watched it, and it covers some of the basics about the Federal Reserve. Just the main things to remember is that the Federal Reserve is the bank of banks. So our Wells Fargo bank that we go to actually has a bank that it puts its money in, and that's the Federal Reserve.
Interesting.
Yeah, so the Federal Reserve can loan Wells Fargo money, and Wells Fargo can keep money at the Federal Reserve. Do you know where our closest branch of the Federal Reserve is?
Downtown Atlanta.
You're right.
Ooh.
Yeah, right here, right where this box is right here. You can see there are 12 Federal Reserve banks located throughout the United States. And because they are the bank of banks, they only really interact with member banks. So we couldn't go open a checking account or a savings account or anything there. We have to go to our member banks. So when they make a decision, and this is where the headquarters of the Federal Reserve is located, when they make a decision, it gets disseminated to these 12 member banks. And then within those regions, they can set interest rates, they can loan out money to all the banks that people like you and me would go to.
Cool.
All right. So before we launch into monetary policy, a couple notes that hopefully y'all will be writing down in your notes during this flipped lesson are the main goals of the Federal Reserve. And their website, they have 3 main goals that they attempt to accomplish for the economy through operating through member banks. The first goal is to have stable prices so that prices don't go out of control. I told my students about the crisis in Zimbabwe where they had 11.25 million % inflation.
Oh, boy.
Yeah.
Wow.
Yeah, and I showed them a $1 billion bill that was printed in Zimbabwe.
That's awesome.
There's also economic growth is a goal of theirs so that we can continue to grow the economy. And then finally, full employment, which I think is a little bit weird because I don't think it's possible in our country to have full employment. 0% unemployment is never happened, and I don't think it could happen.
Sounds unrealistic.
But I guess, you shoot for the moon, right, and hope you make it. But these are all targets that we've talked about. So inflation, that is stable prices, trying to get that magical 2% inflation. We've talked about economic growth, having GDP grow each year is the goal of our country. And then finally, to get as many people out of unemployed and into the employed column. So that's the goals of what the Fed does with the money supply. But the biggest thing that how they can accomplish these is they can control the money supply. So if we want to create stable prices, right? If we feel like prices are going too high, we can actually take money. The Fed can take money out of the economy. And if the economy is starting to stall and our economic growth isn't happening, the Fed can actually put money into circulation. And we'll see that with their monetary policies. So they can put more money in circulation, they can take money out, And the best part about the Fed is that they can do it way faster than our government can make laws or change their budget. So that's why we have a Fed that can make timely decisions to influence our economy. But the biggest thing that they do when they control the money supply is they can influence interest rates, which serve as like an incentive. So, like when we got our mortgage for our house, right? Like if it was too high, we probably would have waited to get our house.
True.
And the Fed actually can help control, not directly, but indirectly, what mortgage companies charge for housing.
Oh, interesting.
Yeah. So there's also two other tools they have, the buying and selling government bonds, which we'll talk about, and then also something called the reserve requirement. So we're going to cover the interest rates, the bonds, and the reserve requirement as like the Fed's three main tools.
Cool.
Any questions so far?
I don't think so.
Cool. All right, so the three tools, they can change interest rate. That's my symbol for change. And there's two types, so we're really going to focus on one main type. They can sell bonds on the open market, called the open market operations. And then finally, they can change the reserve requirement. So in class, when we talked about fiscal policy that the government can control, Congress only has two tools. They can tax us, and they can change their spending. They can increase taxes or decrease taxes, or they can like shell out money to build more roads or create new parks. But the Fed, on the other hand, has three tools. They can influence interest rates, and that can go into effect like that. They can buy and sell bonds, and then they can change the reserve requirement. All right. So if you're a little bit confused right now, that's fine because we're going to go through each one. But the first one, and one of the most widely used one, is the changing of interest rates. Okay. So just like when we talked about fiscal policy, we talked about expansionary and contractionary fiscal policy. So unfortunately for my students, they have to learn the synonyms. There's easy monetary policy, which is the same as expansionary, because the goal is to make it easier for you to get money.
Uh-huh.
And then there's loose monetary policy, which is the same thing, right? And then on the other hand, contractionary monetary policy, when we're trying to make it harder to get money, they could call it tight monetary policy or hard monetary policy. So there's like three synonyms, and I always tell my students, because next year when they're in college, if they have an intro to Econ class, their professor may use one of the three, and I want them to know.
Yeah.
So we're going to talk about interest rates, specifically something called the discount rate. In class on Monday, we'll hit up the federal funds rate. But for this video, we're going to focus on the discount rate. We'll look at the buying and selling of government bonds and the reserve requirement. So y'all, in your notes, if you can create this chart, maybe give a quick pause, create this chart, and then we're going to fill it in as we take notes. All right? So let's talk about the very first one, the interest rates. So in our country, right, we have the Federal Reserve. We have member banks, right? And this includes even smaller banks, but they're a little bit harder to find logos for. So I just put ones that maybe y'all might bank at or know someone who does. And then over here, this is the public. This is us, right? So we don't ever go directly to the Fed, okay? Instead, the Fed incentivizes banks to get money from them, and then banks give money to us. They loan it out to us.
Right.
So for interest rates, right now, the Federal Reserve has something called the discount rate, and it is 2.75%. Okay? Essentially what that means is banks can, like SunTrust Bank, can go to the Federal Reserve, and they can ask the Federal Reserve for money. And the Federal Reserve can loan SunTrust money. But when SunTrust has to pay it back, right now, they have to pay it back with 2.75% interest.
Mm. So is their interest to their customers also 2.75?
So it's at least that, right? SunTrust is probably going to charge an even higher interest rate to the customers because their goal of SunTrust is to make profit. Right? And so they want to make enough money to pay back the loan, but they also want to make enough so they can open new branches and
Oh, wow.
pay their workers, right?
Right.
So this serves as an incentive for banks to come get money. Um, Sometimes when the Fed wants to encourage banks, they may lower the discount rate. So if they lowered it to like a 1.5%, more banks would see it as an opportunity to go get money from the Fed because they can loan it out, right? They can incentivize their customers to come get money at lower interest rates than when it was at 2.75, right? Like Bank of America realizes, oh, it used to be a lot more expensive to pay back the Fed. Now it's a lot cheaper. And I can offer better interest rates for my customers.
How often does that ebb and flow? Like, how often does it go up and down?
Great question. It really depends on the economy. So sometimes it'll just stay at 2.75 for months. But the Fed is keeping an eye on the economy all the time. And if it feels like if the Fed says, hey, we want to get more money to people, we're going to incentivize banks to come to us. They're going to lower the discount rate. Now, there's one catch to the discount rate, which is that it's kind of a negative stigmatism. Like when consumers hear that their bank went to the Fed, it's like, well, do they need money? Why do they need money? Right?
Well,
it's kind of like in the chapter in the textbook, which I didn't make the kids read this year. It talks about like it's like asking your parents for money.
Right.
Like, are you financially responsible?
Mm-hmm.
But I'll tell you, when the housing crisis happened, the Federal Reserve raised or lowered the interest rate to almost zero, and then they allowed anonymous loans, so that banks didn't have to like let their customers know they were getting a loan from the Fed.
Oh, interesting.
Because the Fed was like doing everything they could to get money into people's hands.
Yeah.
So the opposite would be true, right? That if they raised it to 4.5%, like even fewer banks would want to go to the Fed.
Mm-hmm.
Not only is there their stigma, but it's like, oh, well, I got to pay them back a whole lot, which means I'm going to have to charge our customers like 7 or 8%, and then no one's going to come get a loan from us.
Right.
So that would restrict the amount of money going to the people. Right? So if the Fed wants to speed up the economy, they'll lower the discount rate, and then banks will loan that money out.
Mm-hmm.
And if they want to slow down the economy, they'll raise the discount rate, right? And fewer banks will go to them, and then fewer people will go to their banks for loans because the interest rate would be really high.
Yes.
Just like when we were buying a house.
Right.
If it's too high, we're not going to go.
Exactly.
All right. So if we're trying to expand the economy, right, then what should we do with the discount rate?
Lower it, right?
Good. Mm-hmm. Yeah. And then obviously if we're trying to slow down an economy that's growing too quickly, right, we want to
raise them.
Perfect. Yeah. Learning Econ right here.
Yay! First time I actually enjoyed Econ.
Okay, now they're going to think this is cheesy.
No.
All right.
My Econ teacher was so boring. This is way more interesting.
I promise you students I did not pay my wife to say that. All right, so that's the discount rate. In class, we'll talk about something called the federal funds rate on Monday. But if you can get the discount rate, then you're in great shape. All right, so lower for expansion, raise for contractionary monetary policy. All right, let's go to the second tool. All right. Same thing, same setup. Fed, banks, us. Right. So open market operation deals with buying and selling something called government bonds. Treasury bonds. Right. So if the Fed wants to get money to banks, what they're going to do is they're going to buy back previously purchased bonds that banks have bought from the Fed. So these bonds are only to go to and from the Federal Reserve to member banks. So essentially, banks have treasury bonds on hand from previous times they purchased them, and when it pretty much acts like a certificate for more money down the road, right? Like the bank would pay for this from the Fed, and then later on down the road they could cash it in for more money. And so if the Fed really wants to incentivize banks to cash it in, right? If the Fed wants to buy them back, they may actually, for a time, give them a higher interest rate than what they agreed on, so that banks are like, hey, let me sell that back to the Fed. But the Fed then would be buying back these certificates, and in order to buy them back, they must fork over money to the banks.
Are these bonds increasing in value over time?
Mm-hmm. Yeah.
Like the savings bonds my grandparents gave me?
Exactly, except these bonds are only between Fed and banks.
Gotcha.
But yeah, so over time they increase in value.
Because of inflation?
No, it's usually because it's the contract that they agree upon.
Oh, okay.
But they can increase it if they're trying to buy back the bonds. So if the Fed buys back a bond, they must give banks in return. They have to give them cash.
Mm-hmm.
And then that cash goes to the people, right? There's more money being put into the economy, and then the banks loan out that money to us.
I do like the little guy is making it rain on his credit card. I thought those were leaves. That's dollars. I love it.
He's making it rain. All right. So the opposite would be true too, right? If the Fed wants to slow down the economy, right, and take money out of circulation, then they would sell bonds, right? They would say, hey, banks, sign up now. We'll give you a greater rate of return in the future, and we'll give you a piece of paper, and in return, you're going to give us cash, and we're going to take it out of the economy, right?
Interesting.
And when banks have less money sitting around, then they loan out less money. Does that make sense?
Yes.
All right.
I think so.
So when the Fed buys back bonds, they must, every time you buy something, you have to exchange money for it.
Right.
So when they buy this piece of paper back, they give money to member banks. And then those banks
pass it on to their customers.
Loan it out to their customers to spend in the economy. When they sell bonds, they take money out of the economy, and then they have less money to loan out to their customers. All right? So if the goal is to expand the economy, right, then the bank wants to do what?
Buy.
Yep. Right? They want to buy back the bonds, right? Which means contractionary, they would want to
sell them back.
Perfect.
All
right. Ready for the last one?
Yes, sir.
All right. So this last one is like the least used one because they don't really like to mess with banks too much on this one. But the reserve requirement, I don't know. I'm about to find something about my wife on recording. So when you were growing up, did you ever think that banks just you gave the money to the teller and they just took it and they put it in a vault and it just stayed there forever?
Yeah, I picture just walls of stacks of money.
Yeah, me too.
It's never-ending supply of money.
Why would bank robbers want to go there if they didn't just store all the money?
Yeah, exactly.
But believe it or not, I'm glad no one told me this until I started teaching Econ, or actually until I was in high school. But when I give them my $100, they immediately turn around and they loan it out to somebody else because that's how they make money, right? Their reserve requirement is the amount of money that banks have to hold on hand, right? They're not allowed to loan it out because if they did, banks might loan out all of it. And then, if something like the Great Depression hits and people say, I want my money, they've got no money to give anybody.
So you mean that a required amount that they must keep on location, or you just mean in the bank itself holding onto it, electronically?
Oh, that's a great question. So they don't, back in the day, it used to be they have to store it in the bank. But nowadays, think about in New York City, a Chase Bank that makes, $1 billion.
And so few people carry cash anymore.
Yeah, but if they were to keep 10% in the vault at a huge bank in downtown Manhattan, they would become a huge target.
Oh yeah.
So they are actually allowed to store money with the Fed as well. So the Fed can act as the savings account. Yeah. They don't get a rate of return, but they can store it with the Fed as well. So let's pretend for a second that here's the money that banks have, and all the money that they just collected. The current reserve requirement is 10%. So of that $100 that you gave to the bank is allowed to loan 90 of it to other people.
Gotcha.
Okay, the other $10 they have to keep on hand.
Mm-hmm.
Right. Now that's of all deposits. So if there's $1 million, they'd have to keep 100,000 on hand.
Okay.
All right. So that's what it would look like, right? They have to store this at the bank, or they could also store it with the Fed.
Mm-hmm.
And then the rest they're allowed to loan out. Right.
Mm-hmm.
So the reserve requirement currently is 10%. Right. But if we were to lower it to 5%, right, that would mean that they could keep even less money at the bank and loan out more money, right?
I see. Yeah.
So keep even fewer dollars at the bank, loan out more. That would help us increase economic activity. Okay, and then imagine if they doubled it, right? They doubled the reserve requirement. Banks couldn't loan out as much money, right? They'd have to. But yeah, this is the
But that's double. But
okay.
5 to 20.
Yeah, see, this is. I bet you the students are like, "What is happening?" Right?
Or do you mean double the 10%?
Yeah, double the
reserve requirement.
Reserve requirement.
Okay.
Right. So that what that means is if it goes up to 20%, that means they have to store 20% of all the money at the bank, and they loan out less money. Right. Up here, they could loan out more because they were keeping less at the bank.
Mm-hmm.
Right? So if they lower the reserve requirement, they can loan out more money. And if they raise the reserve requirement, what that means is they have to keep more on hand and give out less to their customers.
I see.
It's not something they do all the time because banks really hate when the Fed changes it because it really alters their way of them making money. Mm-hmm. So this is the least used tool. It's like a drastic measure tool. Like the interest rates they do all the time. The bonds they do all the time, but this is one that they like hardly ever use. Right?
Interesting.
So, if the goal is to increase economic activity with an easy monetary policy, right? What would they do with the reserve requirement?
Bring it down, lower it.
Yep. Perfect. And then what would they do for contractionary?
Raise it.
Perfect. All right. So those are the three tools, right? And then for expansionary policy, if the Fed wants to increase economic activity, like let's say we're in a recession, the Fed after the housing market, they lowered interest rates to like almost zero, right? They were buying back bonds from banks. I don't think they changed the reserve requirement, but they could have if they wanted to. Mm-hmm. They could have lowered it, all in an attempt to get money into people's hands, because when people get money, they spend money.
Right.
Right. Like we just got our floors done. Mm-hmm. We took out a loan to do that.
Yep.
And then we paid people, right, to come do the floors.
Right.
Right. So I mean, luckily we got an interest-free loan, which was great.
Yeah.
Right.
Win-win.
Yeah, but in doing so, we could pay people, and they got money, and then the people who came and did our floors, they then got to go spend that money somewhere.
Yeah.
Right.
It's a gift that keeps giving.
It is.
So when can we do our countertop?
Oh my gosh. This video is about to end. All right. So
it's all for the sake of Econ. Come on.
All for the sake of Econ, sure. All right. So the last thing we're going to do, y'all, is you're going to add this back to your business cycle. Remember, I told you your business cycle sheet is going to look crazy at the end. This is the last thing we're going to add, right? So contractionary, hard monetary policy we're going to do during an expansion to slow down the economy. Remember, that means if the economy is growing too fast, we'll raise interest rates, we'll sell open market operations or sell bonds, right? Sometimes called securities, right? And then we'll raise the reserve requirement, right? If during a loose or expansionary monetary policy, the Fed would lower the interest rates, lower the reserve requirement, and buy back bonds, all in an effort to get more money to people so they can spend it. All right. So, last thing here. Let's practice if there's an economy where inflation has gone really down, right? Like people have stopped spending money,
Mm-hmm.
unemployment has grown, so people are having a harder time finding a job, and GDP has gone down, so another sign that people aren't spending their money. What do you think the Fed would want to do? Would they want to just get people to spend even less money, or would they want them to go out and try to spend money to stimulate the economy?
Yeah, they're going to want to stimulate the economy.
Perfect, right? So, students, pause this, consider what the Fed could do with their tools, and then see if you got each of the three tools. All right. So for this economic situation, the Fed should enact loose or expansionary monetary policy. Okay. Sorry, that should say easy, not tight. That's really confusing. Loose, expansionary, or easy monetary policy, which means lower the federal funds rate, buy back bonds, or lower the reserve requirement. Any of those three things would get more money into people's hands. All right. Okay. Economy 2. Inflation's gone from 3% down to the ideal 2%. Unemployment has changed from 5 to 4%, and GDP has increased by 5% from year 1 to year 2. Right? So everything seems to be in a healthy range. So what should the Fed do?
Hold off, do the opposite of the first scenario?
Well, if we did the opposite, right, then these numbers are likely to change. Right?
Oh, true.
All the Fed in this scenario, actually, because all the economic indicators seem to be in good place,
Mm-hmm.
we would just Fed should just keep status quo. Don't change anything. Don't raise the reserve requirement. Keep interest rates where they are. Don't necessarily buy back in or sell any more bonds. Just keep things where they are. No need to enact really any monetary policy.
Yeah, okay.
Right? Because all the indicators of this economy say we're doing pretty good.
Mm-hmm.
All right. So, Christina, our last example is going to be economy 3. So, inflation has gone from 4% to 10%. Unemployment has gone down from 4% to 3%. And GDP is grown by 6%. So, the last two indicators seem pretty good, but the top one is concerning, right? Because 10% inflation is really high. So, what do you think the Fed wants to get us to do?
Spend less.
Perfect. Right. So, do you think they want to enact expansionary monetary policy or contractionary monetary policy?
So contractionary, to have less money circulating.
Perfect. All right. Let's go through the three tools. The most used one is the discount rate.
Mm-hmm.
Okay. So, will they want to raise the discount rate or lower the discount rate if they're trying to slow the economy?
So raise it.
Perfect. Right. The second one would be, would they want to buy or sell bonds?
Sell.
Perfect. Right. And then last but not least, would they want to raise the reserve requirement or lower the reserve requirement?
Raise it.
Perfect. Come on now. There we go. So the next contractionary monetary policy, raise the discount rate, sell bonds, and raise the reserve requirement. There you go. We've done 3 practice problems. We've talked about monetary policy and the tools of the Fed. And you got to hear my wife. And she hopefully learned something. If not, hopefully she'll lie to y'all and say that she learned so much.
Never lie.
Well, thank you guys so much for listening, and thanks for letting my wife be a part of this recording.
Thanks for having me, guys. Bye.